Hello friends, welcome back to Navkar Digital Institute. I am CA Palak Pavagadhi. We had in the earlier lecture of RTP the theoretical portion including the judicial update and amendments and ordinance. Today, as promised, we will be discussing MCQs from the RTP as well as the descriptive questions from the RTP. There are 12 MCQs and 8 descriptive questions. I'll very quickly try and solve all the 12 plus 8, 20 questions. Friends, it would take approximately 2 hours. But this 2-hour lecture would change your confidence, would change your marks in the examination. So I would request you to watch the particular session, watch the particular lecture very carefully. Friends, let us begin with, first of all, the objective questions. Yes, friends. So let us begin with the multiple choice questions first. There are 12 MCQs given by ACCA in the RTP. We'll solve it one by one. I would be requesting you to have the calculator in your hand so that we can make the calculation very quickly. Let's have the first one. And the first 3 are descriptive. We have the first, going this way, the following are the details relating to 4 resident entities, very specifically said resident entity AB and company, LM and company, PQ and company and XY and company for PY 1920. You are given AB and company a partnership firm, LM and company a partnership firm, PQ and company, LLP and XY and company the partnership firm. You are given the nature of business, retail trade, playing, hiring, leasing, goods carriage, wholesale trading, interior decoration, meaning thereby this is into the specified profession. You are given which system of accounting is followed, mercantile case, now relevant. The turnover is exact 200 lakh, that is 2 crore, 101 lakh, 100 lakh and 50 lakh. You are given the receipt as per RTGS, an amount received in cash and which was not received in the current year but received in the subsequent year. Remuneration to working partner, interest at the rate of 12% to partner. Profit as per books of accounts if they have maintained the books of accounts under section 44AA. And here number of vehicles are given which is relevant only for one assessee. It may be assumed that partner salary and interest are authorized by the partnership deed, relates to the period after the partnership deed and is within the permissible limits of 40B. Meaning thereby whatever the remuneration interest given is as per 40B, fulfilling various conditions. The details of vehicle owned by LM and company which is into the business of plying, hiring, leasing, goods carriage are as under. You are given 3 plus 2 plus 1 plus 1 plus 1 plus 2. Total 10 vehicles they have got throughout the year and hence it can be eligible for 44AE. But let's check out with the MCQs. Number 1. Which of the 4 entities are eligible to declare income on presumptive basis under section 4 under Income Tax Act 1961 for AY 2021? Which entities are eligible for presumptive tax system? Friends, there are 3 presumptive tax system sections in the topic business provision. 44AD is applicable to resident, individual, HUF and the firm. 44AE is applicable to those who are into plying, hiring, leasing, goods carriage, and 44ADA is applicable to those who are into specified profession. Let's check out to whom the particular section will be applicable. Number 1, it is AB and company a partnership firm which is into the retail trade. If they are into retail trade, 44AD can apply subject to the turnover doesn't exceed 2 crore, your turnover is 200 lakh. Whether AB and company can go for presumptive tax system? Yes. Second, LM and company, a partnership firm, has got business of playing, hiring, leasing, goods carriage. If it is the assessee having the business of playing, leasing, hiring, goods carriage and it has got 10 or less than 10 vehicles throughout the year, can it go for presumptive tax system? Yes, it can go for 44AE of the Income Tax Act. Third, PQ and company and LLP which is into the wholesale trading. Wholesale trading means you are about to go to 44AD, but 44AD does not welcome the LLP, and as 44 AD doesn't welcome the LLP, due to the assessee being LLP, can the assessee be eligible for presumptive tax system? No. Friends, XY and company, a partnership firm which is into the interior decoration business and having turnover exactly 50 lakh. If it would have been more than 50 lakh, it cannot go to 44 ADA. That is a presumptive. But if it is exactly 50 lakh, yes, it would be open for them to go to 44 ADA, and they can also go to 44 ADA, that is presumptive tax system. ABN company, LMN company and XYN company can go to presumptive tax system. AB, LM and XY can go to presumptive tax system, and is your answer. Your answer will be D for the first MCQ. So you have to be very, very careful while solving the MCQ. You have to be you have to concentrate fully when you are solving the MCQ, because a small mistake may take your mark away. So this is first. Second, what is the business income to be declared by ABN company and PQN company for AY 2021, assuming the entities wish to make maximum tax saving without getting their books of accounts audited? Carefully listen. This PQN company is LLP. It has not opted for, it cannot opt for the presumptive tax system. While ABN company can opt for presumptive tax system, they do not wish to get their books of accounts audited, meaning thereby they are ready to declare presumptive tax system. What should be the income they should declare to have maximum tax saving? Let's check out with the same. Let's check out with ABN company. They are into retail trade. Now the provision for retail trade is that if your turnover is up to 2 crore, you can declare 6% of your turnover or 8% of your turnover, depending upon if the amount is received by you by account paycheck, account pay draft, ECS or any other recognized mode of payment, then it should be 6%. But if it is by cash, then it should be 8%. In our case, friends, out of 200 lakh, can I say rupees 150 lakh is said to have been received by RTGS NEFT for the previous year 1920 itself. Same way, out of this 200 lakh, 30 lakh is received by cash, and remaining amount of 20 lakh is received by RTGS NEFT between 1/4/20 to 30th September 20. That is in the subsequent year. That would do, there is no worry. But friends, can we say over here that my assessee has received 170 lakh by account paycheck, account pay draft, RTGS, NEFT or any other recognized mode, and they have received 30 lakh by cash. Now for 170 it has to show 6%, for 30 it has to show 8%. So for 170, if you go for 6%, it would be giving you 10.2. And for 30, if you go for 8%, it would be giving you 2.4. 10.2 plus 2.4 will be giving you 12.6 is my total answer. Mind well, from this 12.6, no expenditure are deductible, including the remuneration and interest payable by the partnership firm to partners. So no expenditure would be eligible for deduction, and hence here it is going to be 12.6 is the answer of the first entity. And PQN company LLP cannot go for the presumptive tax system under 44 AD. It is applicable only to resident, individual, HUFN firm, and hence LLP has to declare the income as per the books of accounts only, that is 4.5 lakh. So the first entity should declare 12.6 and the second entity should declare 4.5. Your answer is going to be A. 12.6 and 4.5 would be your simple answer, friends. So that's how the things would work. You have to be very careful, I'm repeatedly saying, while solving the MCQ. The third one, what is going to be the business income to be declared by LMN company for AY 2021, assuming the firm wishes to make maximum tax saving without getting into their books of accounts audited? Friends, it is the third one is for LMN company. Can I say LMN company is into plying, leasing, hiring the goods carriage? Now, if it is into plying, leasing, hiring goods carriage, they can declare their income to be 7,500 rupee per month or part thereof for each vehicle owned by them. If the vehicle doesn't have the capacity of more than 12,000 kilogram. But if it has got more than 12,000, more than 12,000, equivalent to or more than 12,000 kilogram, then it can declare 1,000 rupee per friends each kg, and they can have friends 1,000 rupee per ton per month or part thereof for which the vehicles are owned by the assessee. Very important word here to be kept in mind is the owned. See friends, so if I check out with the presumptive under 44AE, try and concentrate. For this first vehicle, I have to declare 7,500 rupee per month. For second also 7,500, 7,500, 7,500. Very important here, there are chances of mistake. Exactly 12,000 kilogram. It would also be 7,500 rupee per month or part thereof for which the vehicles are owned by the assessee, because that 1,000 rupee per ton per month or part is applicable only when the capacity of the vehicle exceeds 12,000 kilogram. Here for this 13,000, can I say it is 1,000 rupee per ton, meaning thereby 13,000 rupees per month or part thereof for which the vehicle is owned by the assessee. Now if I check out with this, can I say here there are 3 trucks multiplied by, this is important, you have to have date of purchase till the year end. It is purchased in the month of May. As it is purchased in the month of May, put to use on 1st June 2019, put to use would be relevant point only for the depreciation, not for, be careful, this presumptive tax system 44AE. The word of 44AE is it is owned. Friends, I tell you, I appeared in intermediate in November 1997, wherein 44AE full-fledged question, at that time it was an amendment, full-fledged question on 44AE was asked, and the mistake I have committed is I have applied the particular limit, the amount from the day the asset is put to use. Friends, if I have committed the mistake and I obviously may not have got the marks, I would be very careful in solving, and I would be requesting you to learn from my mistake and don't commit the mistake. It would be from May to March. It is going to be how many months, friends? 11 months. At the same time, if I put it this way, for another second part of the truck, it would be from not 1st August but 31st July. So July, August, September, October, November, December, January, February and March will be giving me 9 months. At the same time, the third one will be from the month of August. It is going to give you 1 truck, 8 months. It is going to give you 1 truck from the month of September, not from the month of October. Put to use is irrelevant, I am repeatedly saying, so it would be 7 months. And now it is 1 truck from the month of November, so it would be 5 months. And the last but not the least is it is going to be only 2 trucks for how many months? 4 months they are put to use. Friends, my taxable income is going to be 7,500 multiplied by 3 multiplied by 11 will be giving you 247,500. Then the second one will be 7,500 multiplied by 2 multiplied by 9 will be giving you 1,35,000. Again, I have 7,500 multiplied by 8 will be giving you 60,000. I have 7,500 multiplied by 7 will be giving you 52,500. I have 7,500 multiplied by 5 will be giving you 37,500, and 13,000 multiplied by 2 multiplied by 4 will be giving you 1,04,000 is going to be my presumptive tax system presumptive income. If I make the total 1,04,000 plus 37,500 plus 52,500 plus 60,000 plus 135,000 plus 247,500 will be giving me 636,500. Expenditure are not deductible. But remember, if you go for 44 AD, no expenditure are deductible. You cannot even get the remuneration and interest payable by the firm to the partner. But if it is presumptive tax system under section 44 AE, this 7,500 or 1,000 rupee per ton per month would be the income from which all expenditure are not deductible except the remuneration and interest payable by the firm to the partner. Can I say in our case, working partner salary, and it was clearly mentioned as per 40B is 1,50,000 and interest is 50 lakh. Friends, sorry, 50,000. So can I say from the same you would be able to get 2 lakh rupee expenditure deductible. This would be giving me 4,36,500. So your answer is going to be C over here, 436,500. You need to check out, friends, and friends, you need to understand how this answer is derived at. Next one. What is the income or to be declared by XY and company under their profit and gain from business and provision for AY 2021, assuming that the firm wishes to make maximum saving without getting the books of accounts audited. XY and firm wants to make maximum saving without getting the books of accounts audited, then they have to declare their taxable income to be, as they are into interior decoration specified profession, out of 50 lakh, can we say they have to declare their taxable income to be 50%? And if they are declaring their taxable income to be 50%, friends, their 50% income is going to be, friends, none other than 25 lakh. That's pretty simple. And now important, what would your answer to subpart 3 and 4 change if firm decides to get their books of accounts audited? Now part 3 is for LMN company and part 4 is for XYN company. LMN company is into the transport business and XYN company is into the business of the interior designing. I'll put this way, if we check out with LMN company, their actual income is coming to 4,10,000, wherein I have declared 436,500 as per presumptive. So if I wish to opt for audit, I can declare 410 and save the tax, meaning thereby my answer would be different. For interior decoration, I have declared 25 lakh. But if I wish to opt for audit, I can declare 20 and I can have the tax saving. So friends, I would be putting it this way, that if firm decides to get their books of accounts audited, then answer in both the cases would be different, as your actual income is less than the presumptive income. As actual income is less than presumptive income, if you solve the sum as per actual, you have lesser income, you would get your books of accounts audited. Friends, this is my first one. 5 points I have covered here. Second, Hari, a property dealer, sold building in the course of his business to his friend Mr. Rajesh, who is a dealer in automobile. Remember, Hari is into the business of this building business only. So Hari is a builder. For him, it would be business income. And friends, Rajesh is into the automobile dealer. Now you are given that who is a dealer in automobile spare parts, for 100 lakh, the building is sold by Mr. Hari, the property dealer. When the stamp duty value was 120 lakh. Friends, for business profession, for selling the stock in trade immovable property, section 43CA will be applicable. And you have to take stamp duty value if it is higher than the actual sales price. Apparently here it comes to 120 lakh. The agreement was however entered on 1/9/2019 and the stamp duty value was 105 lakh. Mr. Hari received a down payment of 15 lakh by NEFT from Rajesh on the date of agreement. Hari purchased the same at 50 lakh on 12th July 2018. Two questions are important, or rather three questions are important. One thing is certain, that for Hari, business profession 43 CA is applicable. Second question here important would be the stamp duty value would be the stamp duty value as on the date of agreement to sale, because if agreement to sale is entered, part or full consideration is received on or before the date of agreement to sale and it is received by any mode other than cash, then you can take the stamp duty value as on the date of agreement to sale. So I will take not 120 as my stamp duty value, but I will take 105 as my stamp duty value. Now important point is my actual sales price is 100, my stamp duty value is 105. Can we say my stamp duty value doesn't exceed 105% of the actual sales price, and as it doesn't exceed 105% of the actual sales price, I can settle, I can take my sales price to be actual sales price only, from which if I deduct the cost, it is 50 and my taxable amount is going to be only and only 50 rupees. So this 50 will be chargeable under the head business and profession. Friends, Mr. Ravi, a retail trader, if we check out with from the viewpoint of Rajesh also, friends, the same sum. Can I say from the viewpoint of Rajesh, he got the property at 100, having stamp duty value of 105 only, which is not more than 105%. So for Hari, if at all they ask the question on taxability of the gift, taxable gift will be 0. Friends, at the same time, Ravi, a retail trader, sold residential, retail trader Ravi is. So for Ravi, it is going to go to capital gain, residential house to Valis, a wholesale trader, for 50 lakhs on 1/2/2020 when the stamp duty value was 70 lakh. The agreement was however entered into 1st August 2019 when the stamp duty value was only 55 lakh. So there is a huge increase in the stamp duty value we can see. Mr. Ravi has received a down payment of 5 lakh by crossed check. That won't work. If agreement to sale is entered, part or full consideration is received as on the date of agreement to sale or there before, and it is received by account pay check, account pay draft, or ECS. Cross check, bearer check, I consider it as good as cash. And friends, if it is by cross check, friends, you have to take the stamp duty value as on the date of sale deed and not agreement to sale. Here I am going to take the stamp duty value to be 70 lakh and not 55 lakh. 70 lakh is higher than 105% of 50 lakh, so I'll take 70 lakh only. And Ravi received the down payment of 5 lakh and so on so forth. Mr. Valis on the date of agreement to sale purchased the building at 32 lakh. So his capital gain will be 28, and for Valis the gift taxable is going to be, he got the property at 50, which is having the stamp duty value of 70. So 20 rupee will be taxable as gift. So this is what I have solved. Now let's go to MCQs. What is the amount of income chargeable to tax in the hands of Mr. Hari in respect of the above transaction, under which head it would be taxable? Can we say, friends, for Hari, business income will be coming into play, 50 lakh rupee we have already solved. One. Second, they are asking, is the amount taxable in the hands of Rajesh in respect of above transaction? If so, what is the amount and under which head the amount will be taxable in the hands of Rajesh? Friends, Rajesh would have been taxed for gift, but gift would be taxable only if the stamp duty value is more than 105% of the actual amount paid or 50,000. Over here it is not. So for Rajesh, the gift taxable is going to be 0. Third, what is the amount of income chargeable to tax in the hands of Ravi in respect of the above transaction, under which head this amount will be taxable? Friends, can I say for Ravi, the amount would be chargeable under the head, friends, can I say capital gain? And what would be the amount chargeable? 70 less 32. I think it is going to be 38. My mistake. So it's going to be, this type of mistakes should be avoided in the examination, friends. Otherwise, even if you know the concept, calculation if wrong, then your marks would be deducted. But here you are lucky. You don't have the option of 28 lakhs. So you will have immediate click in your mind. But please avoid this, because time is very important in the examination. Your answer will be C. 38 lakh will be taxable under the head short-term capital gain. Friends, same way, is amount taxable in the hands of Valis in respect of the above transaction? If so, which amount will be taxable? Can we say Valis will be taxable for the gift 20 lakh under the head income from other source. And now important, is tax deductible by Rajesh and Valis on making payment to the seller? Friends, whether TDS is required to be made under 194 IE. 194 IE says that if consideration is 50 lakh or more, consideration. When they use the word consideration under 194 IA, consideration means not the stamp duty value, it is actual sales price. So if actual sales price is 50 lakh or more, then 194 IA TDS is required to be made at the rate of 1%. Can I say over here it is sold at 100 lakh? So yes, TDS will come. Here it is sold at exact 50 lakh. So yes, TDS would come. Your answer is going to be yes, TDS is required to be made by Rajesh and Valis both, because 194 IA, 50 lakh or above consideration for the sale of immobile property would be subjected to the TDS at the rate of 1%. So this is my third very important point. Let's have the check at the next one. Yeah friends, so let's have three now. The following are the particulars to 4 Indian companies, namely A Limited, B Limited, C Limited and D Limited. There are income details about 4 different companies given. Let's have A Limited and B Limited first. A Limited, they are setting up the business on 1/9/2019, 1/11/2019. Both are into manufacturing business. But remember, here it is manufacturing of here it is manufacturing of apparel. Here it is in Madhya Pradesh, here it is in Telangana, Warangal in Telangana. Your plant machinery value is given, gross total income for PY 1920 is given, particulars of the new employee employed during the year 1920 is given, and you are also given number of employees employed on the date of setting up of the company, that is 1000 employees are employed on 1st September 19 itself, and out of this 1500 employees are getting the salary of 24,000, 500 are getting the salary of 25,100 rupees. Same way on the other way around also the similar sort of informations are being provided to you. C Limited, D Limited details are given. You are supposed to check out with the MCQs. Let me check out with the MCQs of A Limited and B Limited first. First one is, what would be the tax liability of B Limited for AY 2021 if it avails the benefit of tax rate under special provisions inserted by Taxation Laws Amendment Act 2019 by fulfilling the conditions specified thereunder? Assume gross total income reflected under the special provision, meaning thereby the income which you have computed for B Limited over here, that is 280, is as per the special provision, meaning thereby you have got all the basic deductions except prohibited under 115 BAB. Question arises, why I am trying to take you to 115 BAB? Friends, listen. My client has started the manufacturing business. He started the manufacturing business on or after 1/10/2019. I assume that the client is fulfilling all other conditions and hence he is eligible. It is eligible under section 115 BAB, which provides that the tax rate would be 15%, subject to client has to forgo additional depreciation. It has to forgo the deductions under section 80 chapter C except 80 JJAA. It has to forgo 10AA, 35AD and number of other provisions which we have discussed in the theoretical part. Now over here, if my client is having the gross total income to be 2.8 crore, from 2.8 crore on this machinery, normal depreciation is assumed to have been provided with, additional depreciation he cannot get. Friends, he cannot get any general deduction except JJAA. Nov'20 JJAA is available if you are employing new employees during the financial year, and these new employees must be covered by PF. These new employees must be paid the salary by account paid check, emoluments by account paid check. These new employees' contribution to PF and pension scheme must not be wholly paid by the employer, and very important, their emoluments per month do not exceed 25,000. In our case, for B Limited, 500 employees emolument is 26,000. So they would not qualify for JAA. 500 employees emolument is 24,000. Apparently they will qualify, but they should be employed for more than 240 days during the financial year. Check out whether they are employed. They are employed on 1st November 2019, and 1st November 2019 means 5 months. 5 months means 150 days or slightly more than 150 days. Would you be qualifying for JAA? Apparently no, but it's a mistake. How come it's a mistake, friends? Listen. If my assessee is engaged in the business of manufacturing leather article or apparel, then they should be employed for more than 150 days, not 240 days. If you count the days of November, December, January, February being leap year, 29 days, and March, they are said to be employed for more than 150 days. And as they are employed for more than 150 days, they are eligible for JAA. Your JAA is going to be 24,000 per month multiplied by 500 employee multiplied by 5 months, that is November to March. So the emolument is coming to 6 crore, of which 30% deduction is available. So from 2.8 crore, 1.8 crore would be your deduction, and 1 crore will be your net income, which would be taxable at the rate of 15% plus 10% surcharge plus 4% cess. That would be giving you 17.16%. So your tax payable on 1 crore will be 17,16,000 and 000 according to me. Your answer is going to be D over here. You can check out the answer. It's going to be D only, but you have to be very careful on small points. Second, what would be the tax liability of A Limited for AY 2021 if it avails the beneficial tax rate under the special provisions of Taxation Law Amendment Act 2019 in the Act by fulfilling the conditions specified therein, assuming the gross total income reflect the computation under the special provision. Meaning thereby, if my client A Limited wants to go for the new provision, there are two new provisions inserted by the law. Number one, it is 15% if it is manufacturing unit started on or after 1/10/2019. Otherwise 115 BAA, it's going to be 22% concessional rate. In the given case, friends, can I say my assessee has started its business on 1/9/2019, that is not on or after 1/10/2019, and hence it won't be open for them to go for the concessional rate of 15%. They have to settle at 22%. Now with the settle at 22% on, friends, 4.9 crore, you will be liable to pay tax at the rate of 22%. Yes, you are eligible for deduction under section 80 JJAA. Would you be able to get? Apparently on 24,000 years, 25,100 rupee salary employees? No. But as you started the business on 1st September 2019 up to 31st March 2020, you see, your employees are not employed for more than 240 days during the financial year. And as you are into the business of manufacturing of steel, that concessional 150 days is not applicable to you. So JJAA won't be eligible in your case. Your income is 4.9 crore and on 4 crore 90 lakh, your tax will be 25168%. So your tax payable will be very heavy, and your tax payable will be 1 crore 23 lakh 32,320 is going to be your total tax payable. So That's what is going to be your answer. JJAA, otherwise eligible, but in this particular sum not eligible. The reason being you have not employed the employee for more than 240 days. Third, what would be your tax liability of A and B for AY 2021 if they do not opt for special provision inserted by the Taxation Law Amendment Act 2019, meaning thereby they want to go for the old one. Assume that the gross total income reflected under the special provision, ignore MAT. Friends, if they are going for the normal provisions, then if they go for the normal provisions, then 4.9 crore is there. From this 4.9 crore, can I say my client would be able to enjoy additional depreciation? See, depreciation he has already availed, but he would be able to avail additional depreciation. What is the additional depreciation available to my client? Can I say he has value of machinery 10 crore, which is put to use on the same day you started the business. Can I say on 10 crore you are eligible for additional depreciation at the rate of, friends, full rate? And if it is full rate, can I say your additional depreciation will be 20%, 2 crore? If your additional depreciation is 2 crore, if I deduct 2 crore, my net income will be 2.9 crore. No other benefits. Now from this 2.9 crore, my tax payable, can I say, as it is exceeding 2 crore, my tax payable is going to be, friends, in the given sum on 2 crore 90 lakh, friends, that is 490 less 2 crore additional depreciation, you will be subjected to tax at what rate? Let me check. Friends, yours is a new company. You are not opting for 115BAA. If yours is a new company, you cannot go for the 25%. The reason being, 25% is applicable only if your turnover does not exceed 400 crore in the financial year 17-18. You don't have financial year 17-18 any turnover, you don't have existence. So your 2 crore 90 lakh will be taxable at 30%. On this 30%, the surcharge rate will be 7. So that would be 2.1. 32.1 will be subjected to 4% cess, that is 1.284. So your total tax will be 33.384. 2 crore 90 lakh multiplied by 33.384 will be giving you a tax payable to be 9681360. 9681360. And friends, for the second entity, which is into manufacturing of apparel, your income given to you is 2.8 crore. From 2.8 crore, friends, we have got 1 crore 80 lakh rupee deduction for 80 JJAA. In the normal provision also JJAA would be available. Now my assessee would have got on this 4 crore additional depreciation at half rate. Why half rate? The reason being, I've started my entity on 1st November 2019. So that half rate additional depreciation on 4 crore would have been not at 10% but 17.5%. Friends, from 2.8 crore, I have got double JAA 1.8 crore. So I was having 1 crore, which was as per the special provisions as per ordinance of September 2019. Now from this 1 crore, I'll be able to get additional depreciation, and my additional depreciation on 4 crore will be at 17.5%. Why 17.5? Because I have started my unit in Telangana, and in Telangana additional rate of additional depreciation is available 35%. I am able to get half rate. As I am able to get half rate, I'll be able to get the additional depreciation of 70 lakh. Plus, don't forget, section 32 AD would be available if you start the business in Telangana. That would be on that 4 crore at the rate of 15%. 32 AD would be available, which would be 60 lakh. So your income is going into negative. There would be carried forward unabsorbed depreciation due to additional depreciation, and as your taxable income is 0, your tax payable is going to be nil. So your answer over here will be 9681,360 as well as 0 would be your answer. So your answer is going to be D for point number 3. Friends, thereafter, now we have two issues related to C limited and D limited. Let's check out with the question, and thereafter I'll go to the information given for C and D. What would be the quantum of penalty payable by C limited under 270A? Assuming that under-reporting of income is not due to misreporting, that means 50% of the tax payable would be the penalty over here, and none of the additions are made which qualifies under the exceptions to the penalty, that is 270A6. Assume that C limited has not opted for special provisions inserted by the Taxation Law Amendment Act, meaning thereby C limited goes for the normal provision. Friends, the provision for the penalty is for misreporting 200% of tax, for under-reporting except the exception 50% of the tax payable would be the penalty. Over here, in the sum of C limited, they have started the business years back. They are trading of leather goods. Business is in Tamil Nadu. Turnover for the year 15, 16, 16, 17, 17, 18 is 18, 19, 19, 20 given to you. You are given details of income returned and assessed for AY 2021. Your return filed is at 14 crore. Your assessment is made, your intimation is sent with certain correction of arithmetical error or incorrect claim to be 16 crore, and your scrutiny is at 20 crore 143.3. Friends, your penalty would be on the difference between assessed income and intimation under section 143.1, whether with adjustment or without adjustment. Remember, this difference won't be subjected to any penalty. So penalty would be only on 4 crore. Now on 4 crore, friends, if I check out with my tax payable, can I say my turnover in the year 17-18 is 499 crore? That is exceeding 400 crore. So my tax rate will be 30. On 30, I am supposed to have surcharge. Friends, as my income is 4 crore, my surcharge will be at the rate of 12%. So that would be 3.6. 33.6 is my rate plus 4% says. So on 33.6, if I add 4%, it would be giving me 1.344. 33.6 plus 1.344 will be giving me my total tax to be 34.944%. Friends, on 4 crore, if I get my tax payable to be 34.944%, it is giving me 13,97,000, or my mistake, 1 crore 39,77,600. My penalty on the same will be at 50%. So my penalty will be 69,88,800. Let me check out. Do I have the answer 69,88,800? Yes, it would be 69,88,800 would be my penalty which would be leviable. And the last but not the least is, friends, what would be the quantum of penalty for D limited under 270A, assuming that under-reporting is due to misreporting, meaning thereby the penalty will be 200% of tax. Assume that D limited also has not opted for the new provisions of Taxation Laws Amendment Act 2019. Let me check what is the position of D limited. D limited is trading of food grain. It has the turnover of 251 crore, meaning thereby this D limited is, friends, having their income turnover in the financial year 17-18 to be less than or equivalent to 400 crore. It doesn't exceed 400, so they can go for 25%. Now the penalty won't be leviable on the difference between returned and 143.1. The penalty will be leviable only on 2 crore rupee. Now on 2 crore rupee your tax payable will be at the rate of 25%. I made a slight mistake in the earlier, as the income exceeds 10 crore, the surcharge rate was 12%. So here also, as income exceeds 10 crore, surcharge rate on 25% will be at the rate of 12%. That would be 328, and on 28 4% says will be 1.12. So your tax would be at the rate of 29.12%. Your 2 crore, which is subjected to penalty 29.12%, that would be giving you 58,24,000. Your penalty will be double. Penalty will be 200% of your tax payable. So friends, your penalty is apparently coming to 1 crore 16,48,000 rupees is my answer. Friends, these are the 3 big MCQs you are having. Now let me go for the simple small MCQs. I'll not call it simple, but I'll call it tricky but small MCQs. Friends, fourth one, it has got only one question. It is not series of, it doesn't have the series of questions now. A Limited, an Indian company, bought back its listed shares from its shareholder, and B Limited, an Indian company, bought back its unlisted shares from the shareholders in the month of March 2020. There is buyback. Buyback of listed, buyback of unlisted shares. What are the tax consequences of such buyback in the hands of A Limited and B Limited? Friends, up to 5th July 2019, if the buyback is announced and approved by listed company, then the shareholder were liable for tax. If on or after 5th July 2019, if the buyback is approved by the SEBI, then friends, the buyback would be subjected to tax in the hands of company by additional tax under section 115 QA at the rate of 20% plus 12% surcharge plus 4% cess. For unlisted, since years, if I am not mistaken, since 2013 budget, it has been provided that buyback would be liable for tax in the hands of company under 115 QA. And friends, in the case where the company pays this additional tax under 115 QA, the income would be exempt in the hands of shareholder under section 1034A of the Income Tax Act. In our case, buyback is happening in March 2020. Meaning thereby for listed or unlisted, the provision would remain same, and hence the answer will be, there is going to be 115 QA. We call it an additional tax at the rate of 20% plus 12 will be 22.4 plus 4% cess will be 23.296% will be the tax rate. Additional income tax of 23,296 of the distributed income is leviable in the hands of A Limited, B Limited. Income arising to shareholder will be exempt is the first option. Apparently this option is correct, but still let me check out the other options. Income arising to shareholder from buyback of their individual hand, no distribution tax is payable. This is perfectly wrong. Additional income tax 23.296% is leviable in the case of A, that is listed, but not in the case of unlisted. No, leviable in the hands of B, but not in the case of A, that is also wrong. Had the buyback been effected for listed company before 5th July 2019, then answer to the particular question would be D. But as the buyback is in the month of March 2020, it is subjected to the additional tax for both the companies. Next, Mr. Ganesh and Rajesh, resident Indian, aged 60 years and 80 years. One is senior citizen, one is super senior citizen respectively, have not furnished the return of income for the previous year 1920. However, the total income assessed in respect of such year under 144 is 8 lakh and 5 lakh. Is penalty leviable under 270A? If so, what is going to be the quantum of penalty? They have not said anything about misreporting, so I ignore misreporting. I will go for underreporting. For the assessee who is of the age of 60 years, that is Mr. Ganesh, on 8 lakh, your tax payable is going to be, friends, can I say 70,000 multiplied by 1.04, that would be apparently 72,800, and as there is 72,800, friends, can I say, as there is 72,800 tax payable in the hands of Mr. Ganesh, Mr. Rajesh would be subjected to tax on 5 lakh to be 0, because 5 lakh is the basic exemption limit for super senior citizen 80 years and above being resident. You are given that they both are resident. Now on this 72,800 penalty will be 50%. On this nil also penalty will be 50%. So penalty will be 36,400 and penalty will be 0. Your answer is going to be, friends, can we say penalty of 36,400 will be leviable in the hands of Ganesh and penalty of nil. Why nil? The reason being there is under-reporting of income, but that income is not subjected to tax and hence there is no penalty which would be leviable. Friends, you are now given some informations related to the non-resident companies, and friends, let us check out how this particular sum number 6 is going ahead. Friends, the next one is 6th. Messrs. X and Company and Y and Company are non-resident firms in receipt of FTS, fees for technical services, of 20 lakh each for the financial year 1920. So it is X and Company and Y and Company, both are non-resident firm, receiving fees for technical services worth 20 lakh. A Limited is in pursuance of agreement with from an Indian company, A Limited. In pursuance of an agreement with A Limited approved by central government, meaning thereby they've got the same in pursuance of the agreement. Now listen, Messrs. X and Company does not have any fixed place of profession in India, whereas Y and Company has fixed place of profession in India, and contract is effectively connected with such fixed place. Friends, if X doesn't have fixed place of business in India, X is covered by 115A 1B of the Income Tax Act. But if Y has got fixed place of business in India and this FTS is connected with that fixed place, section 44DA will be applicable. You are also given that the revenue expenditure incurred by X Limited for FT8 is 2 lakh. Remember that when the income is taxable under section 115A1B, expenditure under section 28 to 44DB, expenditure under section 57 are not allowable. You could have got the general deduction if given, or you could have got the set off of loss. Unabsorbed depreciation again is not allowable. So you cannot get expenditure deductible. Your net amount will be 20 lakh on which tax will be at the rate of 2% plus. So health and education cess will be 2,08,000 is going to be your total tax payable. 115A1B give a special rate without allowing the expenditure, that is 10%. Now for Y and Company, you are given expenditure for Y and Company. If you go to 44DA, all expenditure are deductible except the expenditure which is not wholly and exclusively connected with this PE. At the same time, any remittance to HO would also not be eligible. Let's check out which expenditure are deductible. For Y and Company, they've incurred the revenue expenditure for FTS 350 apparently allowable, but out of this 350, expenditure wholly and exclusively connected with fixed place of profession in India is only 3 lakh. So 350 is not allowed. Only 3 lakh would be eligible for deduction. Second, amount paid by fixed place of profession to HO otherwise than towards reimbursement. If it would have been expenditure incurred by HO for us and which is reimbursed by us, then it would have been allowable. But otherwise, any other remittance to HO is not allowable. So I am going to get the deduction of not 350 but only 3 lakh. 1 lakh rupee is not eligible for deduction. If I get the expenditure of 3 lakh deductible, 17 lakh. On this 17 lakh, friends, my tax payable will be as it is firm, it is at the rate of 30% plus 4% cess will be giving you 5,30,400. So your answer will be 2,08,000 and 5,30,400. It is going to be, friends, your answer to point number 6 will be C. That is 208,530,400. You are given this particular point for non-resident taxation, international taxation. The next one, A Limited, an Indian company, borrowed money from B, INC, C country in B, CINC in country C, DINC in D country, and EINC in country. The details are as under. BINC is associated, CINC not associated, DINC associated, EINC not associated. Now, important point is If you borrow from associate and you pay the interest which is in excess of the prescribed rate, then it would be disallowable. Apparently, you can see that the interest paid by you is 15 crore, 1.5 crore, 25 crore, 2.5 crore, meaning thereby at the rate of 10% you have paid the interest. Let us check out whether there any other restriction or not. But before going to other restriction, let me have the other clause also, and that is, friends, BINC has provided guarantee of loan taken by A Limited from C Limited. C is not associated, but if the loan of C is guaranteed by my associate, then C would also become my deemed associate. Number one. Number two, DINC has deposited 15 crore to E Limited. D gave 15 crore to E Limited, and the same 15 crore is given by E to me, meaning thereby indirectly it is coming to me via my associate only. So E would also be my deemed associate. The whole interest of 8 crore is said to have been paid by me to my associate only. How come 8 crore? 1.5, 2.5, 1.5 and 2.5 crore is said to have been paid by me to my associate only. Now, if I am paying interest to associate, section 94B will be coming into play. Question arises, what exactly section 94B talks about? Section 94B says that actual interest paid by me to my associate, that is 8 crore, because all are my associate or deemed associate, or interest in excess of, friends, 30% of EBITDA ending before interest, tax and depreciation would be disallowed. Now my actual interest paid is 8. 30% of EBITDA will be 3 crore. So 5 crore. I will be able to face the disallowance of whichever is less, and that is going to be my interest worth 5 crore will be disallowed as per section 94B. It is rule of BEPS will be applicable. We have the next simple. M and N Limited are Indian companies which have to pay interest of 2 lakh and 1 lakh outside India to Mr. P non-resident during the year 1920 on rupee denominated bonds issued in January 19 and April 19, which are of the following statement are correct. Friends, mind well, if the rupee denominated bonds are issued between September 2018 to 31st March 2019, the interest in the hands of non-resident is exempt. If it is issued with effect from 1/9/2019, then only the interest will be taxable. See, it is not the period for which you are earning the interest, but it is the period within which the bonds are issued. Now, if I have the bonds issued on January 19, then the interest will be exempt. April 19 interest will be taxable. So, if M Limited has issued the bonds, rupee denominated bonds worth 2 lakh, then M is not supposed to make TDS, but N has to deduct the TDS at the rate of 5.2%, and hence my answer is going to be C. M doesn't have to make the TDS because interest on the bonds issued by M, as it is between the period for which the exemption was available, and hence there is no TDS requirement, but N has to make the TDS. Interest on the bonds issued by N is taxable. We have the next one, which is from the TP, again from non-resident taxation. Under which of the following cases with arm's length price be determined by considering median of the database? Friends, try and understand. As of today, in transfer pricing, the range concept is applicable. Range concept is applicable only when you have minimum 6 entries in the database. Range means your price must fall within the particular range, and that range is generally 35 to 65 percentile of the database. Now, if you have 6 entry minimum, you can apply the range. If you apply the range, then if you are falling between 35 to 65, you don't have to go for the story of median. But if you go below 35 or you go above 65, then you can go for computation of median. This is TP. This is a technical point of TP. Now, my point is, you are given that here there is no range because there are only 5 entries. 6, 7, 8 entries, you have applied the range. When you are applying the range for 6 and 7 entry RPM and TNMM, can I say, friends, in both the cases, you are falling within the range. If you are falling within the range, then you don't have to go for applying the story related to median. In cost plus you have 8 entry, you have range, but you are outside the range. As you are outside the range, only in cost plus method you have to apply the range concept. Rather, you have applied the range concept, but as you are not within the range, you have to apply the median. Is the concept proper? So your answer correct would be only 4th point, that is cost plus method, that is point number C. Yes, friends. So the 10th one is, Mr. Akash made the following cash withdrawal during the financial year 1920. Friends, cash withdrawal above 1 crore from a current account from a bank, post office, cooperative bank, would be subjected to TDS under section 194N. This provision is applicable with effect from 1st October 2019. But for the purpose of considering the aggregate limit of 1 crore, you have to take the aggregate of the withdrawal made prior to the date the TDS is made applicable, that is up to 30th September 2019, as well as thereafter. So let me check. You have the following cash withdrawal, and which of the above pair are required to deduct TDS on cash withdrawal made by Akash in the year 1920? Let me check out, friends. You have BOI, you have SCB, and you have Repo Bank, and you have SBI. Let us check out with the computation. BOI 70, SCB 45, Bank of India again 50, you have SCB again 15, you have Repo Bank 60, you have SBI 10. See, what I am doing is I am simply plotting the withdrawal and will check out whether it is exceeding the prescribed limit or not. Repo Bank 10, SCB 15, 15, Repo Bank 10, SCB 15 and 15. Friends, Repo Bank 20 and 15. And last but not the least is SBI 75. SCB 15 and SBI 15. So here it is 120. Here it is exact 100. Here it is going to be 105, and here it is going to be, friends, can we say 105? One thing should be certain, that can I say, friends, question is which banks are supposed to make the TDS? Can I say SBI option is done away with? Meaning thereby your point number B is out. Number 1. Number 2. Friends, there are 3 banks from which you have the withdrawal exceeding 100 lakh, 1 crore. Now check out, do you have the whole 1 crore before 1/10/2019? Let me check. Friends, as far as my Bank of India is concerned, I have withdrawn on 1/6/19 and I have withdrawn on 1/8/19, 70 and 50. So the whole withdrawal is before 1/10/2019. So TDS is not applicable on the same. In spite it exceeds 1 crore, as nothing is withdrawn on or after 1/10/2019, no TDS is required to be made, as the provision is applicable from 1st October 2019 only. We have now 2 banks remaining. Standard Chartered Bank, Do you have withdrawal on or after 1/10/2019? Yes, you have huge withdrawal after 1/10/2019. SBI, do you have withdrawal on or after 1/10/2019? Yes, you have. So, your answer to the particular question will be, friends, SBI is done away, BOI is done away, your TDS would be deducted from Standard Chartered Bank and Repo Bank. Only two banks will be making your TDS. They've not asked on what amount, so I'm not involving myself into the same, because you are given 3 years. In this 3 years, answer what is been asked to you, not anything extra, please. Which of the following order are not appealable before the Commissioner of Income Tax appeal? A simple one, theoretical one, but in MCQ. An order of penalty under 271B for failure to get the books of accounts audited. Definitely we are making appeal. Number of cases we are making appeal. Second, order made under 163 treating an agent. It is a part. See, there is a list of the appealable order before CIT appeal given, which covers 163 also. An order of assessment passed by the AO in pursuance of direction of dispute resolution panel. Friends, dispute resolution panel under section 144C consists of 3 Commissioner of Income Tax. If as per their direction order is passed, then the order cannot be challenged to CIT appeal. The order has to be directly challenged to ITAT. So, friends, point C, the order of DRC as per the direction of dispute resolution panel DRP cannot be challenged before CIT appeal. And 12th, which is the last MCQ for me. Which of the following statements are correct in relation to the power of Income Tax Authority to collect information which may be useful for the purpose of Income Tax Act? See, they are not talking about the search, right? They are not collecting information, maybe survey. The Income Tax Authority can enter into the place. Which of the following statement are correct? Income Tax Authority can enter the place of business of the assessee only after sunrise, before sunset. Okay. The Income Tax Authority may enter the place of business only during the hours at which the place is open for business. The Income Tax Authority may impound and retain in its custody for a period not exceeding 15 days books of accounts and the documents inspected by it. If he wishes to retain it for more than 15 days, they have to have the prior approval of the Principal Chief Commissioner or the Commissioner. And friends, the Income Tax Authority can on no account remove or cause to be removed from building or place he has entered any books of accounts or other documents. Friends, number 1, they are allowed to enter into the premise of yours only during office hours. Once they enter, they are not supposed to take away anything. So when they can tick mark, they can calculate, they can mark, identify, but they cannot take away. So if they are not able to take away, the point relevant to keeping it for 15 days is also not applicable. They are not allowed to remove the books of accounts, and hence your answer will be 2 and 4 is correct. That is going to be D is your correct answer. See friends, in MCQs, you have to have thorough clarity over the provision. Otherwise, it is either win or loss. Friends, be very careful about the conceptual clarity as far as the MCQs are concerned. These are your 12 MCQs of the RTP. Friends, let's now go to the descriptive quizzes. There are 13 to 28 questions given. Let's check out one by one. And I'll be slightly quick. We'll be going for the concept, we'll be going for the sections, we'll be going for the provision. But we may not read the exact answer given by the RTP. Obviously, my views and the answer of RTP would thoroughly match. ABC Limited has started availing exemption under ATIC on setting up of a new industrial unit in Himachal Pradesh in April 2011. ATIC is available if you start your business in the northeast state, Himachal Pradesh, Uttarakhand, as well as in Sikkim. In Himachal, you would get the deduction if you start the business up to 31st March 2012. My assessee has started the business before the same. So, yes, he would be able to enjoy the deduction for manufacturing sports equipment. The company has availed 100% deduction for 12-13, 13 to 16-17. And For next 5 years, as it is company, they are eligible to get 30%. Had this been any other assessee, they would have claimed 25%. However, in the financial year 16-17, ABC Limited carried out substantial expansion of its unit by increasing investment in plant machinery by 60% of the book value. See friends, this book value is the book value on 1/4/16. There is an increase of what amount? There is an increase of more than 50%. 60% is the increase. There is a substantial expansion of 60%. Now friends, try and understand. From 17-18 assessment year, ABC Limited claimed 100% profit instead of 30% on the basis of Supreme Court ruling in the case of Arham Softronics. 2019 reported that a fresh period of 5 years qualifying deduction of 100% of profit and gain would commence from the year of substantial expansion, whether the claim of the assessee is correct or not. Listen. Friends, ATIC is available in 3 categories. If you start new unit, which is manufacturing, if you start certain specified businesses, or you have old unit but you go for substantial expansion. Originally there was 10C which is being converted into ATIC. People were having the fear. The fear people means income tax department people, that what assessees would do is that they will start new manufacturing unit, claim the deduction for 8-9 years, thereafter they will go for substantial expansion and claim the deduction for fresh 10 years. So in aggregate their total deduction will be for 18 years or 19 years. To overcome the same, legislature came out that aggregate deduction under ATIC, or I would say 10C, cannot be more than 10 years. So your deduction cannot be more than 10 years. Accepted. Honorable Supreme Court, in the case of Arham Softronics, has said that 10-year limit is applicable. Agreed. But the Act is silent about the quantum. If my assessee has got first 5 years 100% deduction, and now if he doesn't go for substantial expansion, he is going to get for 5 years. If he goes for substantial expansion, then also remaining 5 years would be available. But if he doesn't go for substantial expansion, he will get 30. If he goes for substantial expansion, then they would be counted as first 5 years of substantial expansion only, and my client, my assessee, would be able to get 100%. Supreme Court has accepted this argument that Act is giving aggregate 10-year limit, but Act is silent about the quantum, and hence you can have more quantum. The beneficial provisions are interpreted in the favor of the assessee, and that is what is the argument of my assessee. Friends, remember that here in the given case, whether the argument is tenable in the eyes of law or not. Friends, applying the Supreme Court judgment, apparently you will be inclined to write the answer assessee's argument is correct. But expect the unexpected from ICI. Even if they themselves are quoting the judgment, what is important is they are asking you something about the judgment. Judgment is applicable only if substantial expansion would have been undertaken up to 31st March 2012. That is a day up to which you have to start the business, or you have to start the unit, or you have to undertake the substantial expansion. As your substantial expansion has taken place in the year 2016, friends, the assessee is not fulfilling the condition of substantial expansion, and hence my assessee has to settle at 30% only for remaining 5 years. But had the issue been that my assessee has done the substantial expansion prior to 31st March 2012, then my assessee could have claimed 100% deduction from the year of substantial expansion. In aggregate, it cannot exceed 10 years. So your answer will be whether the, see how to write the answer. The issue covers section 80 IC. 80 IC is applicable to this particular states. I have said it applicable to new unit, manufacturing unit or certain specified business or substantial expansion. What is substantial expansion? Increase in the book value of plant machinery by 50% as on the first day of the financial year. As per the Arham, now the issue involved. Assessee wants to claim 100% deduction for 5 years and subsequent 5 years. As per the judgment of Supreme Court in the case of Arham Softronics. Friends, answer. All the conditions of the assessee are fulfilled. Apparently, Arham Softronics may come to the help of the assessee, but as assessee has not done the substantial expansion prior to 31st March 2012, the claim of the assessee is not tenable in the eyes of law and assessee cannot claim the deduction. Whether the claim of ABC Limited is valid, answer is it is invalid. So you cannot get the deduction of 100%. Please be careful. Friends, second, PQR a company manufacturing footwear and leather products. 150 days employment of the workers would do if it is 80 JJAA. Immediately it should click in your mind. For past 10 years, had net profit of 544 lakh as per the statement of profit and loss account for the year ended on 31st March 2020. Company was subject to tax audit under 44AB. The net profit is derived after debiting and crediting the following. Friends, you are given certain details for which you are supposed to solve the sum. Depre given, sundry creditor given, and so on and so forth, with number of additional informations are being provided to you. Compute the total income and tax liability of PQR Limited for AY 2021. The turnover of the company for the year ended on 31st March 18 was 251 crore. Financial year 17-18 it doesn't exceed, friends, 400 crore. So 25% tax rate would be applicable. Ignore the math. Assume the company does not opt for the Taxation Laws Amendment Act 2019, meaning thereby they are going for the old one only. They are not opting for 22%. They will be able to get 25%. Let's check out. See, the sum is from apparently business and profession. And if I start this, and I am solving it over here only so that I don't have to change the book every now and then. My net profit as per P&L account is 544 lakh, right? Depreciation as per Companies Act is 64 lakh. So can we say depreciation as per Companies Act debited to profit and loss account 64 lakh needs to be added back. Friends, if I add back my depreciation, can I say it would be 64 lakh? Next, a sundry creditor whose dues of 64 lakh were outstanding since long time has been settled at 52 lakh on 31st March 20 based on compromise settlement. The amount waived has been credited to profit and loss account. Remember friends, if there is remission or cessation of trading liability, and as you are given that they are sundry creditor, not unsecured loan, not secured loan, sundry creditor, I assume that the amount reflected in sundry creditor belongs to the trading liability for which you might have claimed, you would have claimed the deduction in the earlier year. Now when you write this off, this amount which you write off should be taxable under the head business and profession under section 41(1) in the year in which you write off. 64 lakh were sundry creditor, 52 is payable. So remaining 12 you have written off and you have credited to profit and loss account. It is credited to profit and loss account and included in this 5 crore 44 lakh. Credited and taxable, you don't have to do anything. There is no adjustment required as it is taxable under 41(1). Third, employer's contribution of 6 lakhs to EPF in the month of March 20 was deposited on 30th June 2020. Friends, remember, if it is employer's contribution, then it is covered by 43B. As it is covered by 43B, it is allowable as deduction if it is paid on or before the due date of filing of return. Friends, as it is deposited up to the due date, that is 30th June 2020 only, no adjustment is required. Interest payment debited 60 lakh, includes interest on term loan 50 lakh availed on 1/4/19 at the rate of 12% towards purchase of machinery during the financial year. Friends, interest debited to profit and loss account is 60 lakh, which is for certain working capital as well as for plant machinery. And for plant machinery, your interest is on 50 lakh at the rate of 12%, for full year 60 lakh rupees. Loan must have been taken on 1/4/19. Let us check out, do we have any other information related to plant machinery? Yes. You are given in information number 2 that plant machinery 340 lakh inclusive of machinery costing 60 lakh acquired on 1/4/19 but put to use on 1/11/19. Friends, interest up to the day the asset is put to use has to be capitalized. Now on machinery, friends, here on machinery worth 60 lakh is put to use on 1/11/19, and for this machinery they are talking about the loan amount of 50 lakh. On this 50 lakh, you have got 12%, 6 lakhs. For the full year, that is 12 months, your interest deductible will be only and only, friends, for 5 months. I am repeating. On 60 lakhs, your interest is 12, my mistake, on 50 lakh, your interest will be at the rate of 12% for 12 months, will be giving you 6 lakhs. Out of 6 lakhs, from 1st April 19 to 31st October 19, your interest will be 350, and from 1st November 19 to 31st March 20, your interest will be 250. This would be allowable and this is going to be capitalized. Now, as you have debited full amount to the profit and loss account, out of this, can I say, friends, 350 rupee interest, 3,50,000 rupee interest is going to face the disallowance. And as 3,50,000 rupee interest is going to face the disallowance, I can add back interest on plant machinery. How much is the interest on plant machinery which is going to be disallowed? 3,50,000 rupees. Now listen, don't forget, this needs to be, friends, capitalized, so it will help me in the depreciation. So do not forget this working note. I'm solving it in rough. You are given the fair answers. Payment of 20 lakh without deduction of XYZ Limited. A subcontractor for processing raw leather supplies by PQR Limited is debited to statement of profit and loss account. If you are making the payment without making TDS, you should be ready to face 30% disallowances. And hence, friends, here your disallowance will be contract charges 6 lakhs is going to be disallowable out of 20 lakh. Now, the company has not made the provisions for an amount of 24 lakh being fair estimate of the amount as payable to workers towards periodic wage revision once in 3 years. Of the revision, the provisions is estimated to be pretty reasonable and pretty certain. Friends, here my company has not made the provisions of 24 lakh in their profit and loss account. If they have not made the provisions of 24 lakh in their profit and loss account, whether that is eligible for the deduction or not is going to be my peculiar question. Friends, in my humble opinion, as the provision is very well certain, the provision is eligible for the deduction. You have not debited to the profit and loss account and it is eligible for the deduction. So this 24 lakh, which is pretty certain, it is not a contingent liability. This provision for wage revision would be deducted while computing the taxable income. Written down value of the asset before allowing depreciation as per Income Tax Act is given as under. I will be checking out depreciation slightly later. During the year 2019-20, the company has employed 24 additional employees qualified as workmen under the Industrial Dispute Act. All these employees contribute to a recognized provident fund. 12 out of 24 employees join on 1/6/19 on a salary of 23,000 per month. 4 join on 1/7/19 on a salary of 25,50,000 per month. 8 join on 1/11/19 on a salary of 20,000 per month, and salaries of 2 employees who join on 1/6/19 are being settled by bearer check every month. Friends, this takes us to 80JJAA of the Income Tax Act. Now very carefully listen. When I started the sum, I said that my client is into the business of manufacturing footwear or leather products. So those 150 days limit would be applicable for JJAA. Now over here for 80JJAA, they have employed how many employees during the year? You check out 24 employees. Out of these 24 employees, all these employees contribute to recognized provident fund. That means they fulfill the condition. 12 join on 1/6/19. So 1/6/19, 12 join. And at a salary of 23,000 per month. I am writing the salary also. Thereafter, you are given 4 join on 1/7/19. At a salary of 25,500 per month. I am writing everything so as to have full clarity while we solve the sum. And 8 join on 1/11/19 at a salary of 20,000 per month. Friends, remember, even if you are joining on 1/11/2019 till 31st March 2020, MCQ was there. They are said to be employed for more than 150 days and they are eligible for the 80JJAA. Friends, the salary of 2 employees who join on 1/6/19 are being settled by bearer check. So, can I say out of this, 2 will not qualify, 10 will qualify. These would not qualify. Why this 4 would not qualify? Because their salary is about 25,000 and about 25,000 you are not going to be eligible, and these 8 employees would definitely be eligible. So your additional emoluments will be, can I say friends, 23,000 multiplied by 10 employees multiplied by 10 will be giving you 23 lakh. For these 4, additional emolument would be 0, and for this 8 employees, it is going to be 20,000 multiplied by 8 employees multiplied by 5. So it is going to be 8 lakh. 8 lakh plus 23 lakh will be giving you 31 lakh. As it is giving you 31 lakh, your deduction under section 80JJAA available will be, can I say, 9 lakh 30,000. So what I would do is, while solving the sum, I know that it is after GTI, but I am taking 930 as my JJAA. JJAA you are given so many times in the RTP, so that is definitely very, very important from the viewpoint of examination, friends. Now you are given 4th information. Employee contribution to EPF 3 lakh recovered from their salary for the month of March shown in the balance sheet under the head sundry creditors was remitted on 31st July. It won't work. If it is remitted on 31st July, it should be remitted up to the 15th of next month. It is hit by 36(1)(4)B. If it is not, then I am afraid the expenditure will be disallowable. Employer contribution up to due date of the Income Tax Act under 139(1). Employee contribution would be due date as per the relevant act, PF Act, and this 3 lakh as not deposited up to the due date, this employer contribution my mistake, employee contribution would be disallowable. Only one adjustment which is left, and that is related to depreciation. Let me check out with depreciation one by one. Factory building 360 lakhs. It is first day opening WDV. Can we say factory building will be eligible for depreciation at the rate of 10%? So your depreciation will be 36 lakhs. Plant machinery 340, of which 60 lakh machinery is put to use late. As 60 lakh machinery is put to use late, can I say on 280 I'll be able to get depreciation at the rate of 15%. So on 280 at the rate of 15%, my depreciation is 42 lakh. And friends, on 60 lakh, but don't forget, in this 60 lakh you have to add back 3.5 lakh. Question arises, which 3.5 lakh? This capitalized interest. So on 63.5, your depreciation is at the rate of 7.5%. The business is started not in the specified states. So over and above this, you would be able to get 10% additional depreciation also. 63.5 multiplied by 7.5 will be giving you your depreciation to be 476,250, and your additional depreciation to be, friends, can we say 635,000. And last but not the least is, friends, can I say I have another two assets, computer. Computer will be able to get depreciation 30 lakh at the rate of 40%. So this would be giving me 12 lakh directly would be my depreciation on the computer. Friends, my total depreciation here eligible will be, can we say 42 lakh plus 36 lakhs plus 476,250 plus 12 plus 635. So if I make the total, my total will be a huge amount, 42 plus 36 plus 476,250 plus 12 lakhs. So my total depreciation is coming to 94,76,250, which would be deducted 94,76,250 is deducted, and my additional depreciation which needs to be deducted is 6,35,000. I think I am covering up all the informations. Make the total, find out GTI, find out NTI. Your tax payable will be at the rate of 25% plus applicable surcharge at the rate of 7% if I am not mistaken, and plus 4% cess is the fundamental. See friends, nothing is difficult. Subject to you have done the provisions of business profession very nicely. Simple concepts are being asked in the examination. You have to simply apply the concept while solving the practical. So this is what is your question number 14, a big one from ICAI. Friends, the next one is sum number 15. Saubhagya, a charitable trust, is registered under 12AA of the Income Tax Act. On 1/4/19, it got merged with Element Private Limited, which is company engaged in manufacturing of furniture. If there is a merger of one trust registered under 12AA with another trust registered under 12AA, then there is no problem at all. But if it is registered trust getting merged with unregistered trust, then you have to apply the provision of section 115TD of the Income Tax Act. All the assets and liabilities of the erstwhile trust become the asset and liabilities of Element Private Limited, which is not registered under 12AA. The trust appointed a registered valuer for the valuation of his assets and liabilities from the following particulars, including the valuation report. Calculate the tax liability in the hands of trust arising as a result of this merger. Friends, so for Saubhagya, charitable trust, applying section 115TD, let us have the calculation. Stamp duty value of the land held is 30 lakh. However, the land is sold in the open market, it would fetch 34 lakh. The book value of the land is 40 lakh. The three values given: stamp duty value, fair market value, and the book value. My friends, mind well, what is relevant is not the stamp duty value, but the fair market value of the land. So this is first point. Second, 75,000 equity shares held in XYZ Limited be traded in National Stock Exchange. The lowest price on 1/4/19, that is the date of merger, being 150 and the highest price is 170. The book value is 134 lakh. See friends, what is important is there are 75,000 in number equity shares. Now these equity shares should be taken over or would be subjected to tax on the basis of the fair market value as on the day when the merger has taken place. Which value? Whether it is opening value or rather whether it is lowest value or highest value. You have to find out the average of these two. That comes to 160 multiplied by 75,000 will be giving you, friends, 1 crore 20 lakh for shares. I am taking into account again the fair market value on the basis of lowest plus highest divided by 2. 55,000 preference shares held in ABC Limited, the shares which will fetch 88 lakh if they are sold in the open market. Book value is XYZ. I am list concern. I am supposed to take into account for preference shares the fair market value. What is a fair market value? It is 88 lakh which it would have fetched if sold in the open market by the trust. Friends, let's have now the look at the next provision, and that is, friends, corpus fund. We are less concerned, we don't have to pay this to anyone. Outside liability 180 lakh. Provision for taxation, we don't have to do anything. Liability in respect of various utility bills being 12 lakh. Friends, I am supposed to deduct only outside liability. So my outside liability is 180 lakh and my utility bills, that is going to be 12 lakh. Friends, so my total is 34 lakh plus 1 crore 20 lakh plus 88 lakh less 1 crore 92 lakh. I am supposed to pay tax on, friends, the differential amount. My differential amount will be I'm 34 plus 1 crore 20 lakh plus 88 lakh. It is 88, 120 and 34 will be giving you 2 crore 42 lakh, right? And my outside liability is 1 crore 80 lakh and my other liability will be 12. So it is going to give you 50 lakh will be subjected to my tax, and my tax on this 50 lakh will be at the highest rate applicable to the trust, at the maximum marginal rate applicable to the trust. And friends, you people are aware your maximum marginal rate applicable to the trust would be, friends, over here 30 plus 12 plus 4 will be giving you 34, an odd figure. So on this you would end up paying 30% plus 12% plus 4%. This is tax rate, this is surcharge, this is cess at the time of liquidation of the trust under section 115 TD of the Income Tax Act. So this is what is related to your trust. We have now the portion related to, I think, non-resident. No, my mistake, resident only. Suresh, aged 60 years, is resident and ordinary resident in India for AY 2021. He owns apartment in Sharjah, UAE, which is purchased on 148 and also has a bank account in Bank of Sharjah. Suresh contends that since the income of 3 lakh for the year 1920 comprising of income from house property and bank interest is less than the basic exemption limit, he did not file his return of income. Number one. Number two. Friends, he is 60 years. He is resident, an ordinary resident. Suresh also contends that the notice issued by AO under section 148 in September 19 for AY 910 is not valid due to the following reason. There is no escaped income relating to that year, and time period of 149 for issuance of 148 has lapsed, and hence the notice is not tenable in the eyes of law. Its assessment procedure vis-a-vis foreign income. Whether the stand of Suresh related to basic exemption limit and related to the time barring of notice be justified or not is the question proper. Regarding the first issue, Suresh has raised 3 lakh rupee. Now as he has 3 lakh rupee, which is definitely applicable to resident senior citizen, it doesn't exceed the basic exemption limit agreed. But if you are beneficial owner of any property outside India under 139(1), even if your income doesn't exceed the basic exemption limit, you are under an obligation to file the return. So Suresh has to file the return, even if his income is below the basic exemption limit or doesn't exceed the basic exemption limit. This is one. So the argument of Suresh is not tenable. Second, Suresh has contended that notice is time barred. The reason being, notice is issued for AY, notice is issued for PY9, notice is issued in the month of September 19 for AY 910. AY 910 you can issue the notice only up to 31st March 16, being 6 years. As 6 years have expired, no notice can be issued. Friends, over here, if any person is having any income outside India or asset outside India and notice is related to the same, then it can be issued not within 6 years, but it can be issued within 16 years. And hence here also the argument of Suresh is not acceptable, not tenable in the eyes of law. So both the contention of Suresh is not acceptable as far as 139(1) as well as 148 read with 149 is concerned. Friends, we have the next question, which is favorite of institute and favorite of mine, and that is Doctrine of Merger. Let's have a check. Himalaya LLP filed return of income for AY 1819 on 23rd July 18. For the assessment under 143.3 was completed on 27th April 19. The AO made 2 additions in the LLP, namely 20 lakh towards unexplained investment and 3 lakh due to 40B, interest paid to partner. LLP aggrieved against the same, contested in the addition of 20 lakh under 69 and filed appeal before CIT appeal. Appeal, however, is decided immediately in February 2021 against the LLP. So now for this section 69 addition, as CIT appeal has given the order, you can only move to ITAT. Now something different comes in the mind of this LLP, may be advised by the chartered accountant. In March 21, after the order of CIT appeal, LLP approaches you to know whether it should apply for revision to Principal Commissioner of Income Tax under section 264 or rectification to AO as regards 40B is concerned. See friends, there is an order in which there are 2 subject matter. One subject matter is the subject matter before CIT appeal. Assessee wants to take another subject matter before CIT for the revision in favor of the assessee under section 264. Can he take up? Answer is no. Why? Because there is a doctrine of total merger applicable. Total merger means once one matter in an order is subject matter of appeal, the whole order merges with the appeal. No matter in the similar order can be subject matter of revision under section 264. So between 246A, that is appeal to CIT appeal, and 264, it is doctrine of total merger is applicable. But for the same, if you want to go for 154, you are allowed to go for 154 because doctrine of partial merger is applicable. Friends, this is one of the most favorite of ICAI, and I would be of the opinion that this is asked almost in all the examinations by Institute. Be careful, there is only one section wherein doctrine of total merger is applicable. Total merger means if any one or more matter is subject matter of appeal, any other matter also cannot go to 264, that is called doctrine of total merger, but any other matter can go to 263, 154, 147, that is called doctrine of partial merger. Only those matter merges with appeal, other matter can be taken up by other authorities, partial merger. Along with that matter, all other matter, the whole order merges with appeal, means it is the doctrine of total merger. Friends, it is the question on merger they have raised. See, I am assuming that the answers in RTP you will read at length. I am giving you the basic idea what is the concept in the answer. I am not reading each and every answer over here. Friends, is issue of notice under 143.2 mandatory for making assessment under 143.3? Can failure on the part of AO to issue notice under 143.2 can be treated as a failure defect which is curable under 292BB if the assessee participates in assessment proceedings? See, what has happened is, my case of say previous year 17-18 is been selected for scrutiny, but 143.2 notice has not come. Directly I am given 142.1 notice and I have participated in the inquiry, in the hearing. Now section 292BB says that if in response to the defective notice assessee participates in the hearing, then that defective notice will become valid notice, non-defective notice. And you cannot argue that notice is defective and hence hearing is defective and hence you cannot pass the order. Don't appear if the notice is defective. The question raised by institute is that if 143.2 itself is not served to you, directly you are called the detail under 142.1. You started giving the detail, you have started complying the notice, the order has come. Once the order has come or order is about to be passed, you are arguing that, sir, as the notice under 143.2 is not issued, the proceeding itself is null and void. AO is arguing that proceeding is valid, not null and void. The reason being, in spite you are not given 143.2, you have participated in the hearing, so that invalid hearing will become invalid, proceeding will become valid proceeding under 292BB. Friends, whether the argument of AO is tenable in the eyes of law or assessee is correct in the eyes of law, remember, notice must be served to the assessee. If the notice is not served, that is not a curable defect under 292BB. If notice is served and that notice is defective, notice must be there. And if the notice is defective, then the notice will become valid. But if no notice is issued, that is not a curable defect under 292BB. And friends, here, even if there is Supreme Court judgment which talks about making invalid notice valid, friends, without notice, defect won't be curable, even if Supreme Court judgment is there. Supreme Court judgment talks about making defective notice non-defective if there is appearance. But if there is no notice, then the proceeding will be null and void and it won't be acceptable to the assessee. It won't be taken care of. Friends, this would be leading me to a simple sum on salary you will fill, but actually it may not be salary. Salary would be only the basic part. They would have definitely number of other things in their, I would say, question which is raised by ACCA. Have a look. Hari, a resident, 42 years. He is resident. Yes, friends. So 19th, it is on for Mr. Hari, a resident aged 42 years, salaried employee with Omega Private Limited. You are wondering that institute is having the salary question in RTP. You will have something different than the salary at a later stage in the same sum. You are given various informations on the salary plus certain contribution for the LIC pension plan or Mediclaim Now important. He also delivered guest lecture in a reputed university in country X. So some foreign income. He received 8 lakh from such university after deduction of 2 lakh in country X, that is withholding of tax, that is TDS, with which India does not have any double taxation agreement. Compute the tax liability applying the DTAA. Friends, let us have for Mr. Hari for the previous year 1920 relevant to 2021. Under the head salary, we have basic salary earned by my assessee, that is 60,000 per month. Multiplied by 12 is 720, plus my assessee has DA 12% of salary. This 12% will be fully taxable. My assessee has transport allowance and medical allowance. So transport allowance 10,000 multiplied by 12 will be fully taxable, and my assessee has medical allowance of 5,000, which is also fully taxable. Now friends, what is important is I have my gross salary, which will be 180 plus 806 400. So 986 400. Don't forget to deduct standard deduction, which is 50,000, and my net taxable income under the head salary will be 936 400. Friends, under the head income from other source, I have income from country X to be 10 lakh, and my GTI being 19,36,400. From the same, my client is eligible to get certain deductions. Now what deductions my client is able to get? He contributed 15,000 to approved pension fund of the LIC. He'll be able to get ATC deduction or triple C deduction, whatever you wants to call, and he also paid 20,000 by cross check. It would do. If it is medical insurance premium paid by cross check, it would do. It should be paid by any mode other than cash. Even if it is cross check, bearer check or account paycheck, ECS, any other mode of payment, it will be acceptable. He paid 2 lakh by cross check for the health of his mother, resident aged at 61 years, who is not dependent on him. Parents, whether dependent independent, will be eligible. Parents, if senior citizen, they would be able to get, the assessee would be able to get 50,000 in aggregate for both the parents if they are senior citizen resident. It is paid for 5 years. So per year, can we say it is 40,000? 18,000 is your ATC, and friends, 18,000 is your ATC, and 40,000 is your ATD. So that comes to 58,000, and friends, as it comes to 58,000, your NTI is coming to 19,36,400 less 58,000, that would be 18,78,400 rupees. If I want to find out my tax on NTI, can I say it is 263,520 plus 112,500? So your tax will be 376,020. I am applying simple slab rate on which I am supposed to add 4% cess. My 4% cess will be 15041 or 40 I'll make. Friends, so my total tax payable will be 391,060. From the same, I am able to get relief under section 91. Now be careful. my relief is available only on double taxed income. I'm not going to get any relief on my salary. I'm going to get relief only on the income earned by me in country X. The question arises, would I be able to deduct these deductions from country X income? Not necessary, is your choice. It would be definitely your choice. Choice would be yours. If you wish to deduct, you can. If you don't want to, you would not. But as you people are aware, if you reduce the double tax income, your relief will be lower. And as here, listen very carefully, these deductions are not directly connected with income. They are investment payment based deduction. You can say that I have got this deduction from the salary only. So you will keep your double tax income as it is, and it would be 10,000 multiplied by your Indian tax rate is approximately 20.81%. The question arises, how come it is 20.81%? If you find out 391,060 divided by 1878,400, then it comes to, friends, 20.8182%, or foreign tax rate is 20%. How come 20%? On 10 lakh there is withholding of 2 lakh rupee. You can get the relief of whichever is less, that is only 20%. So 2 lakh would be your relief, and your net tax payable will be 191,060. Mind well, friends. Now if you have any TDS in India, if you have any TCS in India, advanced tax in India, then it would be deducted from this amount 191,060 only. So it's a simple one, but it is salary merged with DTAA with general deduction. The last one to close. Examine whether the transfer pricing provisions under the Income Tax Act would be attracted in respect of the following cases or not. The first one, transfer of process of patent by RHO Limited, an Indian company, to ABC, a US company, which guarantees 12. If it guarantees 10% or more of the total loan borrowed by the company, then they will become associate. As they are associated, the transfer pricing will be definitely applicable. Marketing management services provided by Athena, a Greece company, to Alpha Limited, an Indian company. Athena is a specified foreign company. Friends, specified foreign company means the company in which our Indian company holds 26% or more of the voting power. 115 BBD is the concept. Now, if they are having 26% or more voting power, then they will become associated under 92A2. And as they are associated, provisions of TP definitely will be applicable. Gamma Limited, an Indian company, has 2 units, Delta and Phi. Unit in Delta. Delta and Phi unit. Unit Delta, which commences business 4 years back. This is an Indian company. It commences business 4 years back, engaged in the development of a highway project for which an agreement has been entered with central government. If the agreement is entered with central government for developing highway, then it is eligible for 80 IEA, now shifted to 35 AD also. Unit Phi is carrying on the business of trading in steel, meaning thereby unit Phi is not eligible for any benefit. Now you have 2 units. You have Delta unit eligible, you have unit Phi not eligible. Unit Phi transfers 25,000 metric ton of steel for the value of 30,000 per metric ton to Delta for 20,000 per metric ton, meaning thereby Phi has transferred to Delta steel at a lower price to keep the profit of Phi lower and Delta higher. Would it be acceptable? Friends, you will be hit by domestic transfer pricing. If inter-unit transfer is made not at fair market value, AO has right to make the adjustment, and domestic TP will be coming into play here, as the value of the transaction covered by domestic TP here exceeds 20 crore. Yes, this would also be covered by TP. And last, purchase of machinery by Beta Limited, an Indian company, from Huff AG, a German company. Beta is subsidiary of Up. No way out. They both are associated. As they both are associated, definitely the transfer pricing will be coming into play. Friends, these are your questions, MCQ and descriptive from RTP. Its institute publication released, I would say, around 2 months before the examination. As it is released 2 months before the examination, Institute is giving its own publication. Friends, I would be requesting you to be very careful about the same. This lecture, if you watch, then I am confident that you will have clarity over all the 12 plus 8 questions. I would be requesting you to be very clear about the concepts given in the RTP as well as the other concepts, and I wish you all the best on my personal behalf as well as on behalf of Navkar Digital Institute, and hope to see you very soon as professional colleagues. Hope you will come out with flying colors in the examination. Thank you very much, friends. Stay home, stay safe, so that you can prepare well and perform well in the examination. Thanks a lot.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.